right. Looks like we're set up and rolling. Just gonna do a little random afternoon live stream today. Just got back from the gym, so I don't know what's been happening. But we'll see if anything pops up. See if anything moved this morning after BA. The trading video from today is not out yet. That comes out at 2. But that's actually going to be showing a red day because the BA trade here happened after I edited my video. But that's okay. Just gonna chill out, drink my protein, have my lunch, be here till maybe 3:30, something like that. Just hang out this afternoon. All right. I did not see any of the Fed news that came out while I was at the gym. Or has it not come out yet? Is it at 2? For some reason I thought it was this morning. Let's see if CNBC... Oh yeah, it's still hasn't happened yet. Is it on YouTube? Oh, it starts at 2 on YouTube. Okay. How do I bring this up just on YouTube? CNBC TV on YouTube. There it is. Okay, so apparently it's at 2 today. So, let's see what happens to the market when that hits. Otherwise, be hanging out, eating lunch, and seeing if anything pops up. Market made a little bit of a move here before the announcement. So possibly some news of what's going to happen already out there. Disload. Let's see what Kano ended up doing. Guys in the room are saying not much has happened after the BA move today. I wonder if this is something that we can watch live on stream. It's gotta be, right? It's just news. I would think you could watch just news. I don't know. Does seem like everything's just sitting and waiting right now. Ain't nothing moving. Oh, there's a bunch of people out there watching this, I guess. Beginner Trading has 90k subs? Jeez! Go back. There we go. Market seems to like the expected announcement coming up. Has rebounded off of the bottom. OMI, no volume there. Not interested in ATNM.
this is
Excuse me. Man, how do people do afternoons? I've been here for like 10 minutes. I'm already bored. Man, BA, what a crazy mover. That's a picture perfect intense move into bear flag, though. Already on hood. mean, Hobie's a good move. There just ain't no volume there at all. Absolutely no volume. Is all in one candle right here. FRPT. Also light volume. Alright, well, let's turn on desktop audio. And then we'll bring over the Fed and see what happens. Perfect. Whoa, we're getting a pop right here, right as it's starting. Everything popping. Look at the market. Made a ridiculous pop there and then right back down. It must be happening, and the official announcement is out. Crazy. Market liking it. Holy smokes. Huge move in the market here. MVST.
MVST.
Maybe if we get a little bit more there. Like up through 280. Everything popping with the market move. Why is this not on yet? Still waiting. Question is, do I want to try any of these? I mean, they're obviously all doing the same thing.
Dollar.
See what the market has done here.
Dang spy LOL.
There's the official news. Kid is going crazy. Where you at, CNBC?
W up.
It'll be interesting to see what happens once he actually starts talking. Oh, band is now at highs? Yeah. Still just waiting. MVST maybe gonna try. You can try small size if it gets up through 85. Put the SPY up on my other screen here.
FRPT up 2.
I'll bring that back up if they go live. Market's still going.
W dollar. Out all. MVST more dollar.
Mm. Guess they're not going to go live until they actually come out and start talking. That's kind of lame.
VCSA up.
hearted. TIL popping, but also volume issues and range issues there.
Till crap daily.
Also daily chart issues there. Thank you, David. Guess they're coming on at 2:30. Ooh, the season finale is on today. I am watching that later.
VCSA out scratch.
You know, there's a friends and
MVST done.
Wait, coin moving a little bit. If you got like 66.50, could try it real small. Boom. When are you going to start, stream? Oh, they updated it to 2:30. Okay. So we'll see if it goes live at 2:30. Watch some of that. And then, if nothing happens, roll out. Market making a move towards the highs here before Powell starts speaking words. We'll see what happens once he starts talking. What stupid thing are they going to say today that gives up this move is the question. What are they going to say?
Nova interesting. We'll watch for VE.
All right, pushing the highs here. Is it going to go? Is this stream going to start? Oh, here we go. Okay. Let's watch what they have to say here. I gotta change that. PTC? Whoa. What's going on here? Going crazy. Maybe
PTC.
over 124, extremely
Good
small
afternoon.
size.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal.
All right, we'll try some
We
here at
have both the
124.
tools that we need and the resolve it will take to restore price stability on behalf of American
Only
families
20
and
shares because
businesses.
I don't know what this is.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability,
I'll just look for a
we
move
will
back
not
down under
achieve a sustained
123.
period of strong labor market conditions that benefit all.
Put it out at 123,
Today,
2290.
the
See
FOMC
if we can
raised
fill
our
down
policy
there.
interest rate by 75 basis
all
points,
filled.
and we continue to
So a little
anticipate
win.
that ongoing
Little win to add to the
increases
day.
Dollar.
will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace.
You don't say.
Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed
going
from
again?
last year's rapid pace, in part reflecting lower real disposable income and tighter
Yeah.
financial conditions. Activity in the housing sector has
126 this
weakened
time?
significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices
PTC assuming it's an earnings leak.
And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's
Call
war
is
against
after the
Ukraine
close
has
today.
boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
And right back down.
Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we
PTC dollar.
Determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity.
And mark it right back down. There it is.
Called
it here first on stream.
As I've said in the last two press
as soon as they started talking,
it will become appropriate to slow the pace of increases.
And look at it go.
As we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go.
Stop B/E.
And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than
news
previously
comes out.
expected.
People start talking.
Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2%
Makes you think
goal,
what would happen if they
longer-term inflation
just
expectations
announced the news and didn't also
Reducing
have to come
inflation
make
is
themselves
likely
a
to require
spectacle.
a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
Hoo
Thank you,
hoo,
and I look
at
forward
Guru
to your
David.
questions.
Thank you. Colby Smith with the Financial
Nice
Times.
trading with
On the
ya,
need to slow
LOL.
The pace of rate increases at some point. Is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good
No
evidence
crap.
of that would be a series of down monthly readings. Of course,
Really? You can tell inflation's coming down by the fact that it comes down?
That as the appropriate test
These
for
guys are
slowing the pace of
geniuses.
increases or for identifying the appropriately restrictive
How do you
level
know it's
that we're
coming
aiming
down?
for.
Well, if it comes down.
We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial
Oh,
conditions have
PTC.
tightened.
Now you make me look dumb, but that's
the
okay.
effects
I
that
want to be
tightening
careful
is
with
actually
it.
having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program.
Does that mean you don't want to answer it?
And hit to talk about the statement language along the way. So I
That's
think
what it
you can
sounds
think
like.
about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming. And it may come as soon as the next meeting or the one after that.
So basically that was a long-winded way of saying we don't know.
About this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamaros of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. There are many, many models that look at that. And, I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
I'm gonna be honest. I don't know a
Hi,
damn
Chair
thing
Powell.
about
Thank you for taking my
underlying
questions.
inflation.
Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us.
We ain't even
That's
close
what we
to
really
2%.
need to do and what we're strongly committed to doing.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to the lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is, it's a commonly for a long time thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And, the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy, whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory,
and we've given
as
up
we make
all
these
the
ongoing
gains
rate hikes and
officially
policy becomes
from
more
the
restrictive,
announcement.
it'll be appropriate to be thinking more
and
about
are
it. Of course,
lower
we think about
since then.
The lags are just sort of a basic part of
They
monetary
just need to
policy,
stop
but
talking every
we will be
time
thinking about
they
that.
make an announcement. I mean, look at this.
But we won't
Announcement
be,
comes out,
I think we'll
chilling,
be considering
starts
it
talking.
because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to.
I kind of want to stab
to
this,
that level
but
of
it's a freaking
sufficiently
semiconductor ETF.
restrictive, and we don't. Of course, we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting, a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios.
Market
As you look
really
around the
dumping now.
economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. Sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say housing.
Well, tried to get it there at
housing market
59.90, did not
very
get it.
overheated for the couple of years after
See
the
what it
pandemic,
does.
as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very carefully, much more carefully managed by the lenders. So it's a very different situation. And
Tried to
doesn't
get it, just
present
didn't get a fill there up at
potential financial-
59.80.
Doesn't appear to present financial stability issues, but no, we do understand that's really where a very big effect of our policies is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range
Tried
of
to
data
get it. Oh, well.
on the unemployment.
All right, it's about 3 o'clock, so
I'd start with.
I think I'm going to shut it down.
unemployment,
Thanks
which
for
is
those of you
typically
who
the
stopped and
single
watched this random
statistic you would
afternoon
look to is
stream.
at a
Appreciate
50-year
it.
Low, 3.5%.
And we'll catch you
We're getting-
guys later this week with the regular videos. And the one that came out today, although it doesn't show the green trades, it only shows the red trade because I got that while I was editing my video. So, have a great one all. I'll catch you later.